In the IBC community, there's kind of a kid gloves treatment, I think, of Dave Ramsey, which is that we acknowledge that he helps a lot of people who are not good with money. But we got to remember here, bad math is built into a lot of his assumptions.
He thinks whole life is just the company taking care of two things for you. He thinks whole life insurance is they've given you term and taken the other 95 and put it into a savings account. There is no savings account. The cash value is just what the current thing is worth. And he completely misunderstands that.
We've analyzed the product forwards and backwards for hundreds of clients and ourselves, and it is a very, very powerful tool in our toolkits. What we're going to do is demolish this misunderstanding of cash value. He's either lying or he doesn't know. We're not debating here. We're telling you what it is and what he is saying. All of this is incorrect and belies any understanding of the product.
Hey, good morning, Hans.
Good morning. What's going on?
Nothing. Welcome back for another Remnant Finance episode, man. Just in my world, I'm finding out how much of a challenge that move really is. It's been a month and we're just like all in, knees deep in work. And I think the last time I moved, it was kind of our starter house. Like we had an apartment before that, but we had such little stuff because it was such a tiny apartment. It's like I have a memory blank of what this is.
Every time you talk about it, it makes me think about our upcoming, as in like within 2 years, time frame move, most likely across the country. And really not looking forward to it if it's been this much of a headache for you to move 3 miles down the road.
That's probably part of the headache, though, is because it's so easy to go back and forth and leave some stuff here and get it later and still taking care of this place and getting it ready to sell. Like you won't have a house to sell, which will be a benefit. And if you just do a full move, which would be the most logical thing to do across the country and pay a company to just load it all up, take it all and put it all in place, it'll probably be a little bit easier. But like the fact that you live 3 miles away makes it seem like, oh, I can take care of some of it. And you're kind of bouncing around and getting that house livable while at the same time getting this one sellable is just absolutely overwhelming. And working a couple jobs.
Yeah, I can imagine. This will be our first move without the military. I mean, as low quality as the overall service is when you do a military move, it's free. So you don't really think about that aspect of it. But I just looked briefly at like what it costs to move cross country, and it's insane. So
Is it?
not really excited about that.
You might be better off just selling half of your stuff and starting over.
Yeah, definitely. I think you just accumulate so much stuff over time. And for those who know our situation here as far as housing goes, like we got a really fortunate deal here. And based on where we were living before in Cambridge, Massachusetts, in a small 100-year-old, 2-bedroom, duplex, to come into this house, like we came with 2 bedrooms worth of stuff, and now it just naturally expands. And so we're probably not going to be in a place like this wherever we go next. So definitely going to have to trim down a little bit, but we'll see. Not really focusing on that yet right now.
So I told my wife if we move again, we're probably just going to dump almost everything and start over and just go furniture shopping and dish shopping and everything else we need and just pretend like we had a fire and just start over.
Yeah.
Anyway, so on the agenda today, man, we've had 2 separate people send us Dave Ramsey videos that obviously, as everybody knows here, he doesn't like whole life insurance. So you watch the videos, we see the errors in his thought process, and we thought we would do a little response to those.
In the IBC community, there's kind of a kid gloves treatment, I think, of Dave Ramsey, which is that we acknowledge that he helps a lot of people who are not good with money get back to even. He helps you get to zero. If you're in debt, he helps, psychological tricks, not tricks, psychological tactics to help you get out of credit card debt or get to even. Now, there is good intention there for sure, but beyond that, I'm not going to just blanket ascribe good intention on the growth side of it once you get to zero. It's a red flag to me when someone has an emotional reaction to a financial product. Like, this is just a tool. It's a financial product, and we can make a comprehensive case, and we do regularly, as to why it is such a powerful foundational tool that almost everyone should have. So when someone's just getting emotional about it, there's something more. It's not about an analysis of the product. It can't be, because we've analyzed the product forwards and backwards for hundreds of clients and ourselves, and it is a very, very powerful tool in our toolkits. Now, if we hear someone talking about buy term and invest the difference, which is what he says, we will give our rebuttal and we'll use numbers. We'll make a case. But like, if someone says I'm going to do that, I'm not furious. I don't have like an emotional anger to it. And so the fact that when this topic comes up, he gets so angry is very telling, because there's something that's off here, and it's the understanding of the product. It most definitely is. But there's got to be some other kind of motivation, and I can't say what that is, but certainly get paid handsomely to push a different tactic that we believe is less advantageous. What we're going to talk about today is something that's not debatable. Like, we're going to tell you what specifically what cash value is and what it is not. I've got a lot of thoughts here, so I'm going to pause before I run for 20 minutes.
Yeah, let's just jump right into it.
Welcome to the Ramsey Show. Hey, Thomas, Merry Christmas.
Merry Christmas to you too, Dave. Thank you so much. Hello, gentlemen. How you doing?
Great, man. What's up?
Nothing. Quick question. First of all, I just wanted to preface it by saying, Dave, I've been listening to your show for a while, and I really want to thank you for all your advice. I used to be one of those people that really just thought about, well, yeah, I can afford that payment. I can afford that payment, and just all of a sudden, I'm just under this massive amount of debt. And after listening to you for a couple of months, I've just basically restructured the way I do everything. I'm just, stop buying stuff. I'm getting my debts paid off. Within a couple of years, I plan to be completely debt free. So thank you very much for your advice. My question is, I've heard you talk a little bit about whole life policies. Now, my wife and I right now have whole life policies. They're good until we're 125 years old. We have about $1.5 million in coverage. Costs us about $680 a month to have that. And I've heard you sort of say that you didn't think they were a great investment, but I haven't really heard you get into any details about why you think that is. So I was wondering if you could just talk about that a little bit, and maybe I'm missing something, and if I am, I'm sure you'll hit the point.
Okay, sure.
Before he even starts, I want to point out one thing, is that whole life insurance is not an investment. We don't need to go into detail on that. We've done it in the past, but it's not an investment at all. There's no risk of loss. So let's see what Dave says.
Well, the overarching main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x.
That is relatively accurate for, I just did a 40-year-old 20-year term, and it was $6. I ran a side-by-side comparison. So there's some accuracy to that on a term product.
We cover this in previous episodes, but a good reminder here. The only policy that matters is the one when you die. If you're talking about price, this is accurate. Yes, the price tag is cheaper on a term policy for the same death benefit than a whole life, and that's because the value is cheaper. The price and value are two different measures here. So it's correct just to say price is lower, and the reason for that is because actuarially, 99% chance you will outlive that, and now you will have no insurance. And so, yeah, of course it's going to be cheaper because the value is not there. There's nothing you can do with it in the meantime. There's no living benefits. All you have is a binary. If I die during the term, it pays out. If I don't, and only 1% or so do, then it becomes a sunk cost when I outlive it. So yes, the price is lower. The value is also correspondingly lower.
Part of the reason for that is when he's talking about this 20-year term, he's also talking to somebody who, in Dave's world, we're going to insure you until you're a millionaire and retired based on doing his baby steps, and then you're self-insured. So he's also talking about the cost of that insurance on a young, healthy person who's unlikely to die. If that person were 60 and tried to get a 20-year term, it would be exceptionally expensive. If that person were 70 and tried to get a 20-year term, it's going to be tens of thousands potentially. It depends on their health rating at that point. It just keeps getting more and more expensive. So it's true for that snapshot of time for, let's say, a 30, 35, 40, even 45-year-old. When you start going above that and get into a 20-year term, those numbers aren't going to work either anyway. It's not going to be $6 or 6% of the cost. That's going to continuously go up as you age. And there's a reason you're closer to death. And whole life insurance has that factored in. It's going to guarantee that you get a payout when you die, not if you die.
And this ignores all the living benefits, like the many, many things we use that we're using today.
He's only comparing death benefit to death benefit in a short period of time that isn't even a valid comparison. So I'm going to hit play.
And for the insurance, obviously, whole life, though, has another component to it that term does not have. You're obviously aware of that. You spend a lot of money on this. And that other component is a cash value buildup. Now, the cash value buildup is the other $95 out of $100 approximately. Could be $91, could be whatever, but it's somewhere in that range. Nationally, across the top 10 whole life insurance companies, it is $95. Okay, so $95 going into cash value, $5 purchases the same amount of insurance, life insurance. Now, so then the gripe that those of us have that hate whole life insurance, and it's not a mild dislike, I hate it, is that what happens to that $95? And in cash value, what you will do, and you're well past this, but if you went back and looked at your policy pages, your cash value buildup for the first 3 years, your savings buildup is zero. 100% of the $95 goes to fees. It's front loaded as an investment, which in and of itself is not necessarily evil. It's just frowned upon in the financial planning world by and large. The second thing is that once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%. Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes.
That's a good point to pause. The first thing I thought is there's no talk of structure. There's no talk of what type of company. Is it a stock company? Is it a mutual company? Are there dividends? He'll actually, I think, bring that up. I watched this a couple weeks ago, and I can't remember if he talks about the mutual aspect. 1.2% is just flat out wrong. I mean, I wish I would have gotten it ready. I can show some products from one of the companies we write with that just shows a plain old vanilla whole life insurance with no paid up additions, as we've talked about in previous episodes, that shows a long-term internal rate of return of north of 4%. Internal rate of return, if that was even the metric that mattered most. And that's tax-free basis. That's an annualized basis. So I don't even know where he gets 1.2% to start, probably from a stock company.
Yeah, I don't know. And of course, that's without dividends. That's without increasing the size of your policy via PUA. Like this, again, over and over, it should be a red flag to you that if the word investment is used continuously, you're not talking to someone who has a comprehensive grasp on this because of the role that this plays in your financial strategy. We both invest. We work with people that are investors. We believe in investments. This is not an investment. I don't know how many times you need to say it or how many times it needs to be said before you can internalize that. But to keep saying it this way means you're not putting it into the proper comparison. So you're automatically going to be making a bad comparison right off the bat. And we got to remember here, bad math is built into a lot of his assumptions because the psychological elements of how to, for instance, get out of debt trump, in his strategy, like the snowball method is mathematically inefficient, right? To take the smallest value debt versus the largest interest rate debt, right? You're not paying down the largest interest rate first. You're paying the smallest, magnitude of a loan. And you snowball that because you get the psychological hit, right? You want the victory of clearing off that loan. That's a psychological value. There is value in that for sure. Some people need that.
Definitely.
But you are objectively doing it less mathematically sound certainly you're spending more money to do that, all other things equal, right? So if we're going to make an accurate comparison here, to do the snowball method is inefficient relative to paying off the highest interest rate first. That's not debatable. And so you have to remember his audience might need that, but that is not mathematically sound advice, right? And so a lot of these perspectives and a lot of the people that need his advice are people who need the psychological hit. If you don't need that psychological hit, like if you can break down and understand why the snowball method is inefficient relative to paying off the highest interest rate first in every situation, you probably don't need this quote financial advice, this investing advice. Because again, like when we're not even talking about the right terms here, we're totally off base here. So just take that reality that what his audience needs. He's never calling someone who can thoroughly debate this or knows the ins and outs or spent 1,000 hours on it. It's always someone who either is confused or feels duped by it, or someone who writes life insurance but doesn't know how to properly structure these policies. Like if we could talk to him, if Cave Williams could talk to him, if Dave and Paul from Wealth Warehouse podcast, like there's a lot of people that could talk and could thoroughly win this debate, because it's not a debate.
It's not a debate, but I think it takes out a major part of it. Like part of his baby steps is to save 3 to 6 months in emergency fund, and then he's done saving. So there's a serious question, and something that needs to be addressed is like, does he ever analyze what a person's spending habits are if you broke it down to like their daily burn rate of money, what they spend every day, if you averaged out all their expenses of their life? And what if a life event comes along and he's telling them to max out their 401k or put it in growth stock mutual funds? Do they have liquid reserves to survive a major event? Do they actually have a savings plan in an optimal environment? Do they have money on the sidelines to take advantage of an opportunity? So there are no opportunities that exist throughout the baby steps. They are very dogmatic, like you're going to invest in growth stock mutual funds, period, dot. Well, if something comes along that is a great investment that fits your DNA for what you want to invest in, or something, or a house, like the dream house that comes along, the dream car that you've always wanted when you are out of debt and you're doing things, do you have liquid cash that you can hop on an opportunity when it presents itself? You know, if you've always wanted whatever that dream car is, so a classic car, and you find out that one neighborhood over, somebody passed away and their daughter's trying to offload it for an extremely good price, but you don't have cash to jump, well, you're going to keep waiting for your dream car. And that's not even an investment thing. It's not even a wealth building thing. But there's never discussion of a cash reserve and the optimal place to hold it in Dave's life. And that is massively important. Like, you know, with all this tariff discussion, with all this Doge stuff, with people potentially losing jobs, with the airline industry potentially going into turmoil for something that we're somewhat connected to. Like, if somebody gets laid off for 2 to 3 years, are they going to tap their 401k because they're going to destroy that wealth that he talks about building? Like, what about having cash on the sidelines ready to rock whenever you most need it to be protected?
Yeah. And we got to remember, this is always an effort to get you into mutual funds.
And part of my point there too is like, even at if he's right and it was 2%, although we know it's wrong, if you're thinking about that rate of return, you know, having your money in an optimal environment where it's protected, it has a guaranteed increase, guaranteed premium, non-guaranteed dividends, but they come along, it's creditor protected, it provides a death benefit, all of these benefits that we've gone through in detail on life insurance. To store your capital in that environment is the absolute best place you can store it for when life happens, and life is going to happen. And so his is always thinking about, you should be getting north of 10%, but when life happens, that's not what you're worried about. You're going to go into a panic if you have no liquid cash that is readily available and stored, accessible, and still doing a job for you, even when you're using it to get through that life event.
Yeah, taxable brokerage account is like, for not financial advice, I don't know your specific situation or your understanding of like your financial literacy, but in my mind, I'd have to stretch pretty far. I'd have to eliminate a lot of superior options. I'd have to have nowhere else to put my money if it's going to go into a taxable mutual fund. Like, to me, that is the last possible bucket that I would fill, because I'm relying on compounding, which is uncertain. I'm relying on market growth, which is out of my control, and I'm being taxed on that. and I'm paying, like, again, when you dive into the fees, and there's a lot of books that go into this, the quoted fee versus the, like a 1% fee on a mutual fund will take away 30% of your projected future growth. You can prove that out with calculator, but it's more than, even if they say 1% or if they say 0.5%, it's way more than that when you factor in all of the low charges across the board. And so I know that Dave would look into a whole life policy and try to pick apart, find how expensive it can be. Well, okay, if you're being honest, let's look at a mutual fund. You're not paying what you see as like the management fee, on the prospectus or whatever. Like it's much more than that. And everyone in the financial industry knows that. That's not debated. Like everyone knows that's the case. And so to get to the point where you need where your money is optimized in a taxable mutual fund, to me, is like there's nowhere else it could go. You have no real estate options. You have no, just your asset allocation model. In my mind, there's no place for that for me, because I don't see any value in that, because every other place I could put it almost has a lot more value. But again, remember, this is always saying, don't do this, go to mutual funds, without any understanding of this guy's situation. What are your spending habits? Who are you? How many people are dependent on you? What if you die tomorrow? What if you die the day after this term goes? And, what other assets do you have? There's never any individual consideration, because it's not about the individual. It's about getting you into mutual funds. That's always the case.
I wonder if he's read Pirates of Manhattan, but I doubt it. I'm going to hit play.
And so it's a horrible rate of return on a long-term investment. And those two things are bad, but the stake in the heart of whole life, and the reason the entire financial planning community that are not in the whole life insurance business have abandoned whole life. No one sells this but whole life insurance agents. No one sells it anymore. No traditional financial planner, no SmartVestor Pro, no one in the financial world sells it. The only people that sell it are whole life agents. They've gone away from it. And this is the reason. Once you've paid the extra $95 to build up, and on your $680 premium, you said you had a $1 million policy?
I've got $1 million. My wife has $500,000, and that's our combined premium. It's
Okay. Okay.
Yeah.
So $1.5 million. If you die, your wife, the beneficiary, I assume, would get $1 million. That's her face.
My daughter. It doesn't matter.
Okay.
But yes.
Yeah.
Right.
Whoever the beneficiary is going to get the $1 million.
Right.
That's
Right.
what they're going to get. That's all.
Right.
If you have a cash value of $200,000 at 2.4%, that you put $95 per 100 in to get to 200,000 or to get to 100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%, and when you die, they keep your money.
It's a good place to pause it.
Yeah, everything about that is wrong, and I'm itching. You can go ahead. I'm itching.
Take it away, man. Take it away.
Okay. What we're going to do is demolish this misunderstanding of cash value. He's either lying or he doesn't know. Okay. Those are the two options, because this is not a situation where we have our perspective on what cash value is and he has his, and maybe you align more with his perspective. Maybe you align more with ours. It's not that. It's not that, we have our perspective on cash value. He has his, and the truth is somewhere in the middle. No, objectively, what we're going to tell you, and if you look at our previous episodes on cash value, if you look at our blog post about cash value, we're going to tell you what it actuarially, which is the science of death, how they price these, right? The study of mortality and how cash value grows is all based on mortality rates, essentially. That's the actuarial process. We're going to tell you what cash value is actuarially, mathematically, legally, for the IRS code. Okay, we're not debating here. We're telling you what it is, and what he is saying. All of this is incorrect and belies any understanding of the product. And so it's either no one's ever told him this, which I don't believe is the case, but it could be the case, or he's lying. But this is not an accurate understanding.
It's not just that, but one of the base misunderstandings he has is he just said something at the end there. He said, so you have a savings account. You've put into a savings account something you're not going to get back. None of your premium goes into a savings account. So that's, I think, his fundamental, either like you said, misunderstanding or lie, is that you have this life insurance. He thinks whole life is just the company taking care of two things for you. He thinks whole life insurance is they've given you term and taken the other 95 and put it into a savings account. Kind of what he tells people to do. There is no savings account. What you have is the current value of that death benefit if it were to be sold today. It is a capital of value of an asset. It's just like your house. When you pay your mortgage, a portion goes to equity. That is not a savings account with a mortgage note due. It pays down and it becomes part of the value of the house. The cash value is just what the current thing is worth. And he completely misunderstands that every time. And I want you to take it away because I'm drafting up a really fast illustration as we speak. And I'm going to show why it is not a ripoff with that illustration.
All right. Yeah. So we're going to talk about what is cash value, like what it is within your policy, what it is as far as how we think about it. But I want to make a comparison for our pilots here. And unfortunately, we lost a client over this who's canceling policies because of this exact video. And the sad part is it's not like we have two differing opinions on this and someone just leans more in his direction. Like this is objectively wrong, and it indicates no understanding of what we're actually doing here and what cash value is. So my analogy is for pilots. You understand, I mean, I don't know about the airliners, what you guys have, but in helicopters, we have two altimeters, our AGL and our MSL. Every pilot knows the difference, right? AGL is above ground level. That's just a radar that pings down and says, here's how high you are over the lowest, or the highest point of the ground below you. MSL is your altitude above mean sea level. And so that's how like you could fly over a mountain at the same altitude and say 30,000 feet the whole time, but the ground beneath you is rising. It peaks and it goes down. And so your radar altimeter, your AGL altitude would say you're getting lower. When you cross the peak of the mountain, it's saying you're super low right now, but then it's going to start climbing. Okay. If you're not a pilot and this doesn't make sense, just with a quick explanation, just go with me here. But for pilots, you'll get this. Dave Ramsey talking about cash value is like you're in the cockpit and a passenger pokes his head in and is like, hey, I know you're flying at 20,000 feet is what you say, but I'm looking down at the ground. The ground's only 2,000 feet below me. You're wrong. I can see the ground. Like this condescending, pompous passenger pokes his head in and says, you're wrong because I can see the ground is only 2,000 feet below us. We cannot be at 20,000 feet. And you're like, okay, hey, thanks, passenger. You can go back to your seat. Have some peanuts. There is two different types of altimeters here. You are referring to one type of altitude. Yes, we are 2,000 feet above the lowest point below us, but as a pilot, we operate on MSL. Every other pilot is flying MSL, our altitude above sea level. We have to consider a lot of factors here. We have to understand what the density and the pressure and the temperature at altitude is. We have to dial in our altimeter. We have to understand that IFR charts are charted based on MSL altitude. So you have one specific measurement that you're looking at and observing, which is height above the lowest thing below us. That's true. You're not incorrect on that, but you're missing all of the nuance and all of the things that keep us safe as a pilot and like all the things that I have to understand. So thank you very much. I'm highly paid to understand the difference here. And I fly according to the one that is optimal, which is what everyone has to do. So we're flying MSL. We're at 20,000 feet. Thank you very much. Have a seat. That is how this feels because you're correct. Their cash value is a numerical dollar amount that you can see on a screen. That's the end of the line for where his understanding is correct. I can log into see an illustration. I can log into my account and I can see a cash value and it is denominated in dollars. That is where his understanding and his assessment of this stops providing value is after that one data point. That's the AGL. Now let's talk about the MSL. What is cash value? It is not this savings account. Like Brian just said, we're going to go all in. We're going to go a lot more into what it is, but this understanding is so fundamentally flawed. And for someone to be swayed by this argument, which is not accurate, which has no value, no bearing on what's actually happening, is very disheartening because someone is going to make a suboptimal decision now, most likely, because we got to remember that money still has to reside somewhere. It doesn't just go away. Money still needs a home. And so anywhere it's going to inevitably end up it'd be doing the same thing, either growing or saving the same way that we're using our policies. I'll continue my analogy. It's like asking your grandpa about Bitcoin. Your grandpa's like, oh, this isn't real money. It's just a digital screen. And you're like, okay, yeah, I understand that, but there's way more to it. Like, you don't understand what you're talking about. Just if an analogy is helpful, that might help for the non-pilots, you know, we're just like, yes, I understand it, but there's way more to this cryptocurrency. I know you don't understand it, but that doesn't really matter, because if you can't explain it properly, we can't really have a comparison or a debate here. So we couldn't even really debate Dave Ramsey because he doesn't understand it. It would more just be like, we have to teach you what this is. We would be glad to. He would never would. Brian's going to run through a visual example here. We're going to explain it in more detail. But remember this, if I find out I'm wrong about something, I want to know, right? If I find out that in reality, mutual companies don't actually pay dividends to policyholders, if I find out that cash value is not what I'm saying it is right now, if I found out I was wrong about this very topic or any topic, I'm not just going to keep putting out bad information just to maintain credibility. You know, the worst thing I can think of as a IBC authorized practitioner, if I had met the client's policy, which if you don't understand that, just it's something we really, really don't want to do. It would be a failure on my part if I had done that. But I wouldn't not tell him if I did that. Like he did it as the policy owner, but if I advised him, if I structured it in a way that allowed that to happen, if I didn't catch it, like if someone's trusting me to provide this advice and then I fail, well, I'm not just going to not tell you out to save face, right? And so it's kind of like if someone's still wearing a mask today, like I don't need to hear their opinion on, you know, really anything at this point. But like, I don't want to hear your opinion about, you know, quote, COVID or anything. Like if you're still wearing a mask today, like into the face of all, you know, all logic, all reasoning, all observable reality, like that's a ridiculous decision. I mean, Asians still do it. I know that, like they did it before COVID. So I'll give them a pass. But if I just see someone else walking down the street in a mask, I'm like, you probably need a helmet. I don't just, you like your opinion. You should change your opinion when information is presented, whether it's that like, yeah, these masks don't work, or you're completely wrong on cash value. You do not understand it. If that is the case, it's intellectually honest to admit and demonstrate that you are capable of learning. Just like who is still giving people advice to buy houses in cash in this market just so that you have equity? It's like you have to change when information presented to you changes and like the circumstances change. So much of this advice I think is just preposterous. But again, if you need the psychological hits of just not having any debt, because you don't want to distinguish between different types of debts and how one's actually an asset, one can be a liability. If you don't want to do any of that nuance and you just want to just forfeit all control and get a taxable mutual fund, like maybe you need that. But for people that are listening to this, certainly, I don't think that anyone's listening to this far into our podcast that needs that kind of advice.
Yeah. So, but let's check this out. Let's actually look at a real example where he's saying they just keep your cash value. Let's show what somebody could do. This is 100%. I want to put this up front, not an optimal way to take cash flow from your policy, but I wanted to do it as suboptimally as possible just to fit this, just to drive it into his narrative. I want to do this as poorly as I could in the least tax advantageous way possible, because his mutual funds, you know, his growth stock mutual funds are going to be a taxable thing anyway. So check this out. I took that guy's monthly premium multiplied by 12 just to make it annual. It makes it easier to work with the illustration software here. So $8,160 is what they were paying. Now they have a much different death benefit. They have there's probably has some term added in, who knows, but that has an initial death benefit for this one person. If I made him 35 years old, standard non-tobacco rating, I made it Dave Ramsey in Tennessee. So that policy would, with this particular company, all companies would be a little bit different, but it would follow the same model. $311,000 initially of death benefit. And you see it goes up every year because they have a dividend. Notice the dividend gives them a cash value at the end of the first year. Although, like Dave said, and he was right, although he said 3 years, the first 2 years, if you're watching this, shows a net guaranteed cash value from the premium of 0. He's accurate in that statement. That's where the fees and the expenses in a policy come from. By year 3, it's starting to do something. By year 4, your guaranteed cash value is improving upon what the policy is doing. But anyway, let's look at this. So real quick, I'm going to just use my calculator and say a verb. Oh, no, you know what? This type of illustration shows the cumulative premium. So because Dave believes in retirement at age 65, if he did that, if this 35-year-old did that for 30 years, they have a cumulative premium of $244,800. At that point, they have a net cash value, non-guaranteed, of $437,000 and a death benefit of $729,000. So if they died today, according to Dave, they're going to give his spouse $729,000 and they're going to keep his cash value. Although he's only paid $244,000, his family's getting $729,000. That's a net perk more than what the cash value is. I don't understand where he goes, but here's what I did. If you start to notice negatives here, notice the dividend, the increase is going to drop. I had this guy start drawing $30,000 a year at age 65. So here at the bottom of the screen at age 66, it's showing that his net cash value is decreasing. What's the life expectancy right now of a man in America? I think is it 78 or 76?
77.4.
All right, 77. So if he just lives to the average American life expectancy, 12 years, he will have taken $30,000 off of that for 12 years. I don't even need the calculator. That's $360,000. At age 77 here, or 78, whatever it was, he will have paid $342,000 in cumulative premium. So he would have taken a taxable gain. So he's taken more than he put in. And if he dies that year, his spouse will still get $503,000, or his daughter, or whomever it is that his beneficiary is. But this guy lives all the way to 95. He keeps taking $30,000 a year. So that's 30 years at $30,000. $900,000 this person is removing from their policy. Some of that's going to be taxable because, like I said, we're doing this the least efficient way possible. So let's take him all the way to 95. He lives a long time and we'll kill him then. He has paid $489,000 into this because he still pays a premium. He's drawn $900,000. His family's still going to get $68,000 more than that. So how are they keeping your cash value? It just doesn't add up. How are they robbing you of something if you've drawn almost double what you've put in and still delivered income tax-free death benefit at 95 years old? So you've utilized this thing the whole time. And you could have done this better. You could have taken probably about the same amount of money and delivered a much higher death benefit without paying the taxes while you're alive.
Yeah, you structured that in the manner that what structure did you use on that? Did you just use all base?
I simply did an all-base policy because that's what he's talking about. So even in that suboptimal cash value environment, we could have made this better. We could have made this way better with the same amount of money. But I wanted to make this as bad as I could. Well, it's not bad because all-base policy drives a really large dividend down the road. So it's not suboptimal, but I'm just saying we could have had higher cash value sooner by using a design that we typically use for infinite banking, drawn money off whole life, and still delivered a death benefit. So more money came out of this policy, a lot more than ever went into it. And it was available your whole life with all those other perks. It just doesn't make sense to me how he thinks you're getting robbed.
This is like just examining numbers here because that's all they do. They never talk about the underlying concepts or what's actually happening. So we're just playing on their field here.
Right.
And I'm seeing tax-free dividends that are about 5x the input premium. So any given year later in life, like in retirement age, you put in $1 of premium and you're getting just a dividend alone, let alone the internal growth of the policy. You're just getting a dividend.
I'm
multiples
dividend by withdrawing money. Because when I start doing withdrawals, my dividend starts decreasing, which would likely, I can't say never, likely wouldn't happen. This is projecting on current environment. The dividend goes down here for like 15 years, and then it still starts to go back up because the policy is that efficient.
Yeah, these are never structured correctly in the argument. Structured the way that we would structure them, but even still looking at this, if you just remove taking that income, because guys, remember using the 4% rule, for instance, is what they always say. We have to make a lot of assumptions here. We have to assume the tax rates are going to stay the same. We got to assume the market's going to go up and right forever without any down years. Average rate of return is a fallacy. But if you're going to take all that into account, we're going to use the 4% safe withdrawal rate. You need about $1 million on a taxable account to withdraw $30,000 a year post-tax, right? We'll call it about a quarter of a tax. I could be off a little there, a couple $1,000s, but $1 million account is what you need that mutual fund if you want to draw $30,000 post-tax from it, give or take a few $100.
And you're only going to leave the balance of the $1 million to your family. You're not going to leave an income tax-free death benefit.
This is all taxable.
And we're not even saying don't invest in the market. I still put some stuff in the market. I with my W-2 job, I still put stuff in the market. Like, I'm not even saying don't do that. Like, But this is just saying if you didn't do that and did this, you could still have the same thing. You're not losing your cash value. You've been able to access all of it and then some and still deliver a death benefit. So it's just wrong.
Before we go a little further into the video, let's just set up what is cash value. This is a good point because he's about to, if you understand at this point in the episode what cash value actually is, if we spend a few minutes discussing that, then as he talks through it, you'll be able to hear the errors. So cash value is the net present value of the future payout. You gave the mortgage analogy. We've used it before. If I make a mortgage payment, I unlock some equity in the home. Some of that goes to interest. It takes time, but over time, more and more of my mortgage payment each month goes to generating equity for me, right? That is not paid up in the first year, but the principal only payments that we use are like the PUA payments we use, we kind of compare to a principal only payment with one major flaw, which makes it even a less accurate comparison. If I make a principal only payment on a mortgage, that entirely goes to cash value. So when we're structuring it that way, when we said this is not structured optimally, it's because we have no component of our annual outlay that's going towards these PUA, going towards this principal only payments on your mortgage, for instance. And so that cash value, whatever that death benefit is in the far right column you showed, that has a value in the future. That future date is either when you turn age 121 or you die, whichever one occurs first. It's going to be when you die. So when you die, that unknown date in the future, that is the future value. Every future value has a net present value. How do we know this? Because what is Dave going to tell you if you invest $100 today? What is he going to do? He's going to say, hey, take that $680 and what's going to happen over 30 years? The market's going to go up 15% every year and you're going to have $1 million, right? He knows there is a difference between the current value of $100 and the future value because he's always going to tell you it's always going to go up. So he lives in the present and says the future we know is going to happen, even though we don't. We don't know what's going to happen to that dollar in the market. We think it's going to go up, but we don't know what it is. It has a future value. What we're doing is we're flipping it. We're starting from the future. Guaranteed, without debate, contractually guaranteed, never in American history has a person not gotten their death benefit from a whole life policy. This amount will be paid to you. So we're going to work backwards.
All right. So I have this guaranteed IOU, $10,000. Today is April 28th, 2025. If I write a date on this of April 28th, 2026, 1 year from today, you're going to knock on my door with this guaranteed IOU and say, pay me 10 grand. How much would you buy that for from me today?
Maybe $9,000.
$9,000. So you're going to get about a 10 to 11% rate of return. You know that in 1 year, that was worth your investment. What if I hand you the same guaranteed IOU, $10,000, trying to get it in focus there, but I put a date on it of April 28th, 2035, 10 years from today? What do you think you might pay me for it today, knowing in 10 years you have a guaranteed payout?
Yeah, if I'm gonna shoot for the same target return, 10 to 11%, I'd say $3,000 to $4,000, $3,500, we'll call it.
$3,500. And actually, I did quick math just now while I was waiting for you to answer it. $3,500, that would come out to $9,938 at 11% per year. So pretty close. So that's a good number. I'll pay you $3,500 for this. What's the point in this, like this little exercise, is that the value of my IOU is worth a lot more if you know it pays next year. The value of my IOU is worth a lot less if it pays in 10 years. It's worth less today. So in the early part of a policy, you got this big death benefit. You took the policy out at age 35. When you're 36, it's far away. So it's worth a lot less money for the company to buy that back from you. And that's what cash value is, actually cash surrender value. It's how much the company would pay you to close the contract, because they're expecting all these future premiums and all this future growth. So it's the amount they're willing to pay you for the policy. Now that closes the contract. It's not like you could then come back with it and be like, hey, what's it worth to you now? But if it's 40 years from now and you're 75, you've been paying in for 40 years, you're a lot closer to that termination date, which is your death, if you haven't already died. So if you surrendered it, your cash value, your cash surrender value is way higher, much closer to that final number, that death benefit number. And so if the company were to buy it from you, because that time is different, the amount of premiums they haven't collected is less, the amount of time they have to put the money to work and earn interest is less. They're going to pay a lot more for it. So it's just the value at any given point in time of that death benefit when it's going to pay. It is not a separate account like Dave treats it, as if they invested it, created a mutual fund, let it grow, and then kept it. It has nothing to do with a separate account. It is the current value of your death benefit in some linear time.
Cash value is value, not cash.
Yeah, exactly.
And so you have that note for 10,000, and always we're going to go back to the comparison because it's a one-way street. It's always don't do this, don't do life insurance, buy a mutual fund, right? Well, let's say what in our analogy, if this $10,000 IOU note that you have, if you held that thing up and you scratched out 10,000 and wrote a question mark, and you said on date, scratch that out and wrote a question mark, how much is it worth now? You'd say, what do you mean? How can I know? So whoever buys this note from me, at some day in the future, unknown, I will pay you some amount in the future, unknown, and then it'll be taxed. How much would you buy it for today? Like, I can't put a net present value on that because I have no certainty. And so Dave is taking we do know the present. We do know that this thing that, this would cost us today $680 for this, or, per month in this guy's case. We don't know the future in the mutual fund. So there is no net present value or future value because there's no net present value because the present value is derived from a future value. There is no future value. We don't know. And again, that's why this is savings, not investing. So it's not an accurate comparison because, again, I have, quote, IOUs like that. I have stocks. I don't have mutual funds. I think that's crazy. But I have financial products that don't have a future value because it's unknowable.
Risk of loss, which is what makes it an investment. This has no risk. This has to ultimately achieve the full value of that note or the death benefit when you're either 121 or dead. But to further the analogy, like the analogy we're making there is basically what I'm saying is I have this guaranteed IOU for $10,000, and the comparison of that is at your death. Except, so, when we draw this little comparison, we're saying you're going to come and collect, but in terms of the contract, that's the death. That's the date of death, right? So to further that and to go one more step in, if we did the 10-year note that you paid me $3,500 for, but in 5 years you come to me and say, hey man, I don't really want this anymore. I don't see the value in it. I should put it in the market. Like, I want the payout now, but only 5 years have lapsed for that guaranteed money of 10,000. Would I, as the guarantor, pay you the full 10,000 when you've only done half of the contract?
No, but you would pay me more than 35 because time has elapsed.
Because I have put that money to work. It has done what it's supposed to do for a certain period of time. So I don't know what the number is. The math doesn't matter. I might be like, hey, you're only halfway through. It's worth 7. Like, I'll pay you 7 at this point because I utilized your money to gain money for 3 or for 5 years, as we said. Mm-hmm. Now, if you came to me in year 9, I might pay you $9,000, not 10. Like, you have to come to the end of the contract, which in my IOU is a particular date. In your life insurance, it's your death. I don't know anybody that lives 121 yet, so it's likely your death. And then they're going to pay the full amount. The great thing about life insurance is it doesn't matter if that death is tomorrow or 60 years from now. It's going to pay the same amount. But what if this caller has only paid his premiums for 6 months and gets into a horrific car accident and unfortunately dies a young man? His wife or daughter would have gotten the full $1 million. I think that's a lot better than the $4,000 he paid into the contract.
And just to, a timely, painful, this past weekend, one of my neighbors here on keep privacy as much as possible. One of my neighbors' 41-year-old son was killed by a drunk driver.
It's horrible to hear.
41-year-old son.
None of us have a lease on life.
We don't have a lease on life. We have no idea when that future is going to be, but that future date, in the case of the mortgage or of the IOU note, will occur. In the case of the death benefit, it will occur. Now, let's say that neighbor, the 41-year-old man, was the one who called in to Dave. And he called in at the beginning of the year and said, hey, I'm looking at $680 a month to put these in force. And Dave says, hey, rather than that, why don't you put it in the market and you'll get 10% a year. And by the time you retire, you'll have $10 million. Well, fast forward April 26th, I believe, drunk driver, he's gone. Okay. Yeah. Now his $680 on 10% interest, had that happened, now we know it wouldn't have. It actually would have gone down a lot from the beginning of the year. We would have had a pretty horrific drop. That $680 might be $300, might be $500. It might be up. It might be $700, but it's going to be what it is now. And it's not going to self-complete, i.e., because that future value was unknowable, there has no change. Whereas had that money gone into the policy, it would have multiplied many, 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 many times over and become tax-free to his family that is grieving and now left behind.
But to be intellectually honest, like if he qualifies, Dave does tell him to buy term while he's young. So to be intellectually honest with that, he would still have term insurance. You know, I mean, I don't want to just act like Dave gave it one or the other. He does tell him to buy term, and we're big fans of term because most of us can't afford human life value in whole life. So he would have had term.
Okay. At age 25, he called Dave and he said, what should I do? And Dave said, get a 15-year term policy because it only costs $5. You're paying 10 times more, 20 times more. Get a 15-year term policy and grow your money. Okay, now fast forward 15 years at age 41, he passes. Now he has no death benefit. And so the only thing that's left in our bubble of like what these same dollars could have done, I don't know what the rest of his financial situation is, but in the bubble of what these dollars could do, they've now had 15 years to grow. Sure, they went through 2008, right? Yeah, they went through 2008. They went through COVID. So they're probably up a lot, but they also just took a big hit in the first third of this year. But they're up for sure. They're up some amount, but now they're taxable. And so again, there's just like with the certainty here. And again, we are even falling into the mistake that Dave makes of comparing the investment to the savings vehicle.
Yeah.
And it's just so easy to fall into because it's so prevalent because he pushes it so much. But 41 years old, just lost his life. Had he just outlived his term that Dave told him to get, his family does not have that protection. And now they have a taxable mutual fund that's going to go through probate, whatever. But let's take it to the real estate analogy. When you have your mortgage, $1 million house, and you get your monthly statement and it says the remaining mortgage is $500,000, what Dave is going to say is that when you sell your house, he's not going to say house, he's going to say policy, but he's going to say when you die, your family gets the death benefit, but they keep the cash value, they keep the equity. That is the equivalent. Like when you look at your mortgage statement, it doesn't say your equity is 500,000. It says our equity is 500,000 as the mortgage company. So you have to deduce between the sale price that you could get and their equity, which is the mortgage balance, what your equity is. So if you say in that example, I have $500,000 of equity in this home, I plan to sell it for $1 million, and I'm planning on getting $500,000 from this sale. Well, when you sell it for $1 million, you don't get to say I get the $1 million plus I get my $500,000 equity. Your equity is your proportional share. It's your pro rata share of the total value of the house, the value calculated by the sale price when the sale price happens. But what is known is the bank's share, the mortgage note, and you get the remainder. And so that is the equivalent analogy here. And he's about to say that. He's about to say that they keep the cash value, which now you should understand is fundamentally flawed. And it's not a difference of opinion. It's objectively wrong.
Let's hit play and see what he says.
Which makes it absolutely horrendous. So you're much better off. And many, many decades ago, the financial planning community, by and large, started moving towards buying term life insurance for the $5 per 100 and doing almost anything else with the 95, but over in the investment world, away from the insurance world. Put it in a freaking fruit jar. At least it's there when you die.
Okay, so you said would your advice be to just terminate those policies and just do what you suggested, purchase relatively inexpensive term life policies and then put additional money? I mean, I do have investments. I mean, I could just up those investments. I invest into mostly directly in the S&P 500. I've got a 401k.
Exactly.
So would you?
But get the term life in place first.
Yeah, exactly. Get your term in place first. Never cancel life insurance until you've got new in place, because we don't want you to have the proverbial milk truck or bus in the middle.
Okay.
Between the two.
So just look at the money I've been spending over the last 5-10 years. Just write that off and just start.
It'll make you want to throw up.
Yeah.
But yes.
But that's the case. Now you will get your cash value out by canceling the policies, whatever it is.
Okay.
It doesn't die. It doesn't die then. But you never get both.
I understand.
You never get the insurance and the investments, and you're always paying for both. And that's the consumer advocate like us, our reason for hating on these things and just saying they're absolutely horrible. It's an antiquated product from the 40s and 50s.
All right, I just want to pause there because I think we've done enough to talk about that. But one more time, like the idea that they're doing both as if they are paying for a $5 premium that's going to expire, and investing $95 on your behalf is just wrong. A whole life insurance policy never expires, but these are not from the 40s and 50s. From the
Actually, way
company,
older than that.
there are companies right now that are approaching 200 years old, still in existence, that have been writing whole life insurance policies in America. Keep in mind, America's only about 250 years old, approximately. So, and the company's been around since basically that time, over 200 years. He's just absolutely wrong about that. He's wrong about a lot. Something he never mentions, and I just want to bring it up because you hear some stuff. I see it online in different places. One thing he's not mentioning is a whole life insurance agent, because he's kind of attacking that in the beginning when he said only whole life insurance agents sell this product. And you get attacked on how we earn income. We earn a commission that is a first year commission that comes off of that, which is part of the reason there's zero cash value. Fact. And we get a very small, like 1% trailing commission, depends on the company, for a number of years after. What he doesn't mention is that like 1 to 2, sometimes as high as 3% annual fee that a fund manager takes is perpetual, whether the market's up or down. So when you look at the long term, now, he's talking about financial advisors as if they're all just, and I mean, I think most of them are probably good people doing the best they can for people, but he's acting like they are the benevolent people that are just doing good. But that model, if you keep your money locked up in funds for 34 years, consistently pays 1 to 3% to that advisor. So the amount of money that they draw off and put in their pockets as income, which I'm not opposed to, it's just the way the model works, is significantly higher than a larger front end commission that we get as a whole life insurance agent. So when he says all of them moved away from this, 30s, whatever years ago, coincidentally, that's about the time that the 401k was created, the mutual funds became popular, that the stock market became accessible to the everyday man. Because if you go back, to say the 1920s, 30s, 40s, even 50s, the stock market was more accessible to the wealthy. It wasn't really exceptionally accessible to the middle class. They used pensions, they used homes, they used whole life insurance to store their money. Some people bought individual stocks, but the way it's available now in the form of a mutual fund just didn't really exist to the scale that it does today. So as that shifted, it was a money-making model. It was not this like benevolent, we can do, everybody does better over here. Like, it also benefited the financial services industry to have your money in their products for as long as possible. And here's something that's interesting. I was just at a little conference, and the president of the whole life insurance mentioned something. He said, when your money is with, let's say, somebody that's at Fidelity, I'm just using them, they're just the brokerage house, but with an investment advisor, and a spouse dies, what do they try to do with the money? When you contact them and you say, hey, my husband, my wife passed away, they've got $500,000 in these funds, what's the first thing, Hans, that advisor typically tries to get them to do?
Well, let's keep it here. Let's roll it over and keep it here and grow it.
What does the insurance company do when the spouse dies?
Pays the death benefit in full, the tax-free estate.
And the money to the family. They don't try to get them to take the death benefit and buy a policy. So these brokerage houses, these investment companies, they want to keep the money in their possession as long as possible. And if it transfers over to a widow or widower, they still want to keep it in their possession where they continue to earn. The insurance company is going to send it to the family, to the beneficiary. Period. Here's your check. Do your grieving. Here's the money that you need. Here's the money that's paid for. Here's for the insured person. Period. They send money out in times of need. Other places want to just keep money in their control. There's something telling about that. And I actually never thought about it until this guy brought it up, and it's fascinating to think about. So point is, like the model did shift, and it became more beneficial to financial advisors as well. And I'm not opposed to them making money. They should make money. They're providing a service. They're helping people gain wealth. But to act like they're just doing good for the good of the people that they represent is not 100% truthful.
Yeah, I don't care how they make money. Like when I buy a stock on Vanguard and it says here's a fee or whatever, Like if I choose to get that, I get what I wanted. I get the stock I purchased, right? If I go through RP Capital and I buy a property and they get their cut as the kind of the broker of that transaction, well, I agreed to a price to purchase a house and I got the house. So like, I don't care how you made money. I entered into this agreement. Same thing with your policy. If you say, here's a premium I want to put in, and I say, here's a policy you're going to get, here's how we're going to structure it, here's what you can expect, blah, blah, blah. It's like, that's what you get. So built into that is the fact that the company has to pay for their property, pay their employees, pay agents. They have to, like, it's all baked in there. You get what you get. And so here's the thing. I guarantee you, go ask an asset under manager, would you rather have hey, these whole life agents are just taking these huge commissions. Why don't you guys just get paid on the first year input? You think they would take that? No. And if you ask me, like, hey, could we take their 1%, could we switch over to their payment model? Like if I can do the same work, like anybody in the world would say, yeah, if I could do the same work and get compensated more because of a different structure, and it doesn't, or in case it does actually impact the client, you lose about a third of your total projected value with a 1% management fee. But leave that aside. If I could offer you the same exact policy, you had no detriment, but I could take an AUM style compensation. Would I do that? Yeah.
Yeah, dude. If I could, like, we're structuring policies for people that are going to have, multiple commas in their cash value. Most of them are. They're going to have millions in cash value.
Yeah.
Like, if I'm looking ahead, it was like, can I get 1% of that a year? Like, thinking long range, as Nelson taught, like I'd be pulling in an excessive amount of wealth when I'm 65 and 70 years old if I could do that model. So yeah, I would trade to that, but it's not the model we build in, and we put people in these products because we believe it is the best place to save in the order of operations that we talk about all the time: protection, savings, and growth. Anyway, I just thought I'd bring that up because I think it plays into what he said there about when the financial industry kind of shifted in the 80s.
That built large buildings in the skylines of almost every city, and that everyone now has pretty well moved away from, except the companies with their name on that kind of stuff. So anyway, all of that to say, now one last part of this discussion that's worth having, because you're obviously doing well financially, and you're doing really good with your analytics on this. The last thing that happens is the irony is that we really don't necessarily need life insurance for our whole life.
Right.
So if you've got $2 or $3 million in your investments and zero debt, and the kids are grown and gone, and you die, well, I think your wife will be okay.
I was looking at it as like, I can die broke if I want to, and at least they'll have this much. But you're right in the sense that I won't be able to spend all my money.
Yeah, but if you put the $95 in a fruit jar, you wouldn't die broke.
Exactly right. Okay, I'm doing it. Thank you, Dave.
Wow. Well,
great discussion.
I thought whole life was going to be like timeshares where it just kind of dies over time, but TikTok has caused a renaissance of whole life agents to start their financial planning influencer careers.
You're kidding.
And so now
they're like whole life guys that are trying to make it cool again.
Well, they're peddling it with new terms.
Make whole life cool again.
You've seen this: index universal life, infinite banking. Dave,
infinite
the wealth
banking.
This is the hack wealthy people don't want you to know.
Infinite banking is back.
Yeah.
Well, right there, you can tell that he's pretty out of the loop and misinformed. He said it's back. It never went away. It's only grown, Dave, because people who understand it do it. Yeah, it's just funny. And we've talked on previous episodes about the need for, like, why is it important to still have death benefit when you no longer need it? I'm going to use the air quotes like this, guy with the ugly smirk on his face on the left here, because it just, read the book, Permission to Spend, is what I'll recommend to the audience. Like, it is going to raise the tide of your entire financial life, and it's going to enable you to have a greater retirement, to spend more in retirement and still leave a legacy. Like, Dave doesn't talk about the legacy. I've noticed that over time, which is probably one of the reasons I veered from him many years ago, is that I'm always thinking about multiple generations in front of me, and he's always thinking about how somebody can get out of debt, make money for themselves, and live in retirement for themselves. I want to see my great grandkids be born into wealth. And that's important to me. It might not be important to him. And there's a whole other, we've talked at length about the importance of keeping insurance whenever you're no longer working and wealthy.
Every generation successive does not need to keep making the same mistakes. Like, we don't need to continue to send kids to college, get in student debt, figure out at age 30 that taxes are a thing, stumble into maybe a little bit of an inheritance when in this case the mom passes and she got $2 million and she spent 1.5 of it. Now the kids are fighting over $500,000, don't know what to do with it when they get it. Like, we are teaching our children, mine are a little too young right now, but my children are going to know like how our family built our wealth. They're going to know what they're going to inherit one day, guaranteed, tax-free. They're going to have a plan for that. They're going to have policies in place to assume that capital. We don't need to keep making the same mistakes generation after generation, but that is the penultimate boomer idea of like, well, just spend it down and maybe I leave some behind, but the kids are on their own, they're grown, whatever. I don't need to. Like, no, my daughters are the most precious thing in the world to me, and they are going to be guaranteed taken care of, and I'm going to set them up to understand that. And like, to the idea that like, all right, they're out of the house, they're not my concern anymore, I can just go on a cruise and I'm good, whatever. Like, that is so foreign to me. And if you believe that, if you're like, whatever, I'll die, I don't need to die anything, if I'll leave something to my wife so she's a little comfortable, but whatever, like, that is totally, I mean, you might as well be speaking German to me, because that is so, I cannot connect to that at all. Two things I have done an exhaustive deep dive in the last 5 years have been vaccines in the medical industry. When I literally forfeited my career over it, as did you. Like, we put our careers on the line. It wasn't like a light decision we made. It wasn't like we're just like, I don't really think so, I'll pass. It was like, no, we studied US code. We studied the manufacturers. We could talk about this thing in depth, right? And said, hey, this is so critical to me that I am going to risk my career over it, end my career over it. There's a lot of us in our group that did that, right? And same thing with the medical side. Like, when it was like, all right, I have to decide. I no longer trust doctors because of the COVID thing. I no longer trust doctors when they tell me your kid needs 72 shots per the CDC. I don't trust you. I'm going to do my own research. I deep dived and looked from both perspectives. I could argue both sides. I got books from both perspectives and made a decision for our family. I feel very confident in my ability to understand that. The other thing that I've done a deep dive in, where I had to totally shift my mindset, was whole life insurance, because I used to listen to Dave Ramsey, and now I realize my input factor was wrong, and therefore my understanding was wrong. As Nelson says, most people's understanding of life insurance is based on someone else's misunderstanding. I am not now paying 6 figures of premium a year into something I don't understand in very great detail. I'm not putting money into cash value that the life insurance is going to keep, the company is going to keep. I'm not putting into some antiquated, it's, TikTok influencers have got to me. Like, I've spent thousands of literally like textbooks on this one single product and the underwriting of it, the mechanics of it, how all of it works. I could talk. I mean, we do this is our job now, is professionally. Like, we talk about this for a living with clients, on the podcast, with each other. You and me only almost exclusively talk about life insurance together. Like, we live, eat, and breathe this stuff. I am not wrong. You are not wrong on what cash value is. And I can say emphatically, Dave does not understand cash value. And it's either he's just never taken the time to learn, or he's lying. It's only those are the only two options. It's crazy, and it's frustrating to me that someone could watch this video with a demonstrated total lack of understanding, phrase after phrase that could be just completely false, and then still decide, after spending hours and hours and hours teaching you, like, do not make a decision based on this video because the information is correct. If you have the wrong inputs, you're always going to have bad information. You're going to make a bad decision if you're trying. Like, just do your due diligence. You cannot do your due diligence and come to these conclusions, because these are false. These are false statements, and we can prove them with actuarial textbooks. We can talk to a CLU. We can talk, like, it's just, it drives me. It's been eating at me, because the fact that so many people have lived this and listened to this for decades and decades, and the church is just infested with this. And hey, you know what? You know what's happening right now? A lot of people have outlived their term, as 99% of people do. And now they have taxable brokerage accounts that, on average, the average 401k balance for 65 plus is $235,000. Okay. Those people don't have life insurance, and a lot of people have very little assets relative to what they need, because they priced that 30 years ago when Dave said you're going to have $10 million. Well, they didn't talk about taxes. They didn't talk about fees. Like, it's so frustrating, because again, we can start at the minute one of this conversation and take that fork in the road of savings versus investing. Our entire conversation here has been as if this is an investment, and it still holds up, but it's not.
Yeah, I wanted to go back into something he was talking about with, I think your wife will be okay. And I just want to say my wife will be better. because she's going to have both. She's going to have the millions of dollars that I've earned through investments, not only through the market investments, the real estate investments, the loans I do. And when I die, she's going to have a pretty nice income tax-free death benefit for the family. Why can't you have both? What a scarcity mindset. Like, we're only going to protect this whenever you're earning, and then we want this amazing pool of money to go away for your family. Like, I will have an abundance mindset. I want them to have that amazing pool of money and this other amazing pool of money. Why can't we have both? It is an and asset, as Caleb Williams calls it. Let's listen to him as a boomer call it tic-tac, because it makes me laugh.
It was a scam from like 20 years ago.
Well, Gen Z is eating it up on the TikTok, Dave.
Oh,
So,
man.
It's caused this resurgence.
Infinite banking is code for whole life that sucks bad. That's what it is. You know, so the infinite banking is you put so much in the whole life that it starts to pay its own
And you
premium.
borrow money from yourself, Dave. It's
and
genius.
you borrow money from yourself. And guess what? There's no taxes on borrowed money. Well, no kidding, doofus. There's never been taxes on borrowed money. If you just run over there and get you a credit card debt.
Oh my gosh.
There's no taxes on the debt, you dumb butt. Of course there's not. Why is
my
I
goodness.
can't believe infinite banking is being made
coming
cool on
back.
TikTok.
Just ignore all
my
of that.
God.
Tic-tac and infinite banking is a scam, and he clearly, as he demonstrated right there, if you've been listening to this and you've listened to all of our episodes, you can see in just those couple sentences that he doesn't understand the process of becoming your own banker at all. He thinks it's just some little tact that you use that you learned on TikTok. So I'm not even going to address that right now because we've gone pretty long.
I just got an email this past weekend from someone who read my article on how to use a policy loan. Real estate investor who's like, hey, I've always heard just buy term because it's cheaper. I've never understood how this integrates into what I'm doing as a real estate investor, because I used how I use my policy to acquire real estate. And so the idea that like, oh, you're borrowing from yourself and the only really advantage of that is that it's not taxed. That's not like, we're talking about the banking function. Never once in this episode, again, zero facts about this person other than he might have $2 to $3 million. That's a wide range. How are you going to get there? For sure, or maybe. What if it's one? You know, but it's never talked about banking control. Like a guy who's a big time real estate investor took the time to email me to say that this made it click for the first time of how I can use this. And you talked about the and asset. I'm not forfeiting my ability to buy rental properties or buy stocks. I'm doing those things. I'm just doing them through my policy more efficiently. And our friend who unfortunately canceling his policies, we can tell what someone's watched just by the questions they asked. And so we didn't need to be sent this link to know that he's listening to a Dave Ramsey clip. When you say things like, so when I die, I just have to surrender the cash value. Like I can't even count on that being there. Like when you're saying things like that, you're demonstrating, one, that you've watched Dave Ramsey, and therefore that you do not understand this at all. But if you want rice and beans and you want your money in a fruit jar, Dave's your guy. If you want, to take small psychological victories over numerical realities, Dave's your guy. It's really frustrating that this conversation can't be had in an unemotional manner. Like I get emotional, I guess, honestly, now that I'm hearing this. But the fact that like, if you're listening to someone who has this emotional boomer take on this this is your grandpa explaining crypto. I mean, this is terrible, terrible advice. And this is the passenger poking his head in the cockpit. And so you can go to flight school and learn how to fly on altitude and on parameters, or you can listen to the passenger who's like, you're wrong. It's frustrating, but it needs to be just, yeah.
Well, it's good to see you get fired up.
I'm hot, man.
All right, man. I think that's good for this one. We're at an hour 20.
All right.
So subscribe, share this, please. Give us a call. Happy to help you. We'll do some deep dive analysis if you need to on why cash value is good, why it's not separate, and why utilizing this wonderful asset is the absolute optimum place to store capital.
And maybe you'll wonder why banks and corporations use this as a asset on their balance sheet. Maybe. We'll figure it out.
That's it.
All right, cheers.